This is Jeff Mucci with RCR Wireless News. We're here in Palo Alto meeting with Tim Chang from Norwest Venture Partners. Tim, thank you so much for hosting us over the past couple days, and thank you for your time. In looking at your background, I read an article you had written about social gaming and smartphones,
right.
the shifting sands.
Yep.
Can you talk a little bit about that?
Absolutely. You know, I think what we're seeing is, in some ways, the third iteration of the app world, if you will.
Yep.
The first one was carrier-based. It was all about getting on the deck, and the carriers were the gatekeepers, right? And the models back then were pretty much, priced downloads, and that's what you had with apps.
Mm-hmm.
And it was really hard for app developers because they had to port their apps across a variety of handsets and platforms, and then they needed to get the carriers to market them. Then the second wave came in. You had a lot of off-deck application stores and off-deck content aggregators, and that worked okay, but you still had the handset heterogeneity, the porting issue you had to deal with, right? Mm-hmm. Then this third wave came in, bolstered by the smartphone. So the reason this is so interesting is that for the first time, you had people buying devices specifically for apps. I would argue that until then, it was all pushing a noodle uphill because you're trying to convince consumers that, hey, did you know your phone can do data? And by the way, there's apps out there. So it wasn't that people were buying phones specifically to consume apps and consume media and everything else, but iPhone and subsequent smartphone launches since then changed all that. Right, and so that then opened up these platforms for a whole plethora of app developers, as well as sort of the web 2.0 and social media app developers to come flooding into the market. Mm-hmm. And what's interesting is they bypassed the carriers altogether. They didn't even know about the deck because they hadn't been in this ecosystem before. What they knew were more, kind of open platforms to them, like the Android App Store and iPhone App Store, and they said, cool, just build apps and sell them there. Mm-hmm. So what's interesting, though, is phase one of the App Store rush was all about, can we build apps, sell them for $4.99, $6.99, $9.99? But then the problem with being too open, you flood the App Store with too many apps.
Right.
Then the gravity of the noise drops the price point down to, 99 cents.
Sure.
And even then, that's too much friction. So the shifting sands I referred to is that this year, going forward, we're going to see a proliferation of new revenue models for the App Store. Not just the price downloads, but what I call apps as a service. Once you get your app into the hands of a consumer, that's just the start of the relationship with the consumer. So it makes sense to drop the price point to free, and you architect your application to make money through in-app transactions on an ongoing basis. But it's a bit different because it's no longer you write an app, you sell it in kind of this fire and forget model. It's more you have to operate your app like an ongoing dialogue, a service with the consumer. Mm-hmm. That's a big change. And traditional app developers, that's a total 180 degrees from what they're used to. Write an app, sell it, move on. Write another app, sell it, move on. Now it's like app as an ongoing service, constant updates, expansion packs, things like that, designed to sell virtual goods or other premium content or upgrades or transactions within the app. Right, so that's what has been learned from the social media companies, especially the game companies like Zynga and Playdom. And then the next phase will even start to layer in subscription models on top of that.
Doesn't that begin to look a lot like the EA model?
A little bit different, actually, because EA traditionally has sold packaged retail software games for $49.99, right?
But they've maintained a relationship.
Sort of they did, but you know what? The challenge is EA creating one-hit franchise. They could milk that franchise for a long time, but there's no guarantee that your new, franchise you start to develop would be a hit franchise.
Right.
You had a few ones you'd count on, Madden Sports and, Harry Potter and things like that. But outside of maybe half a dozen known franchises, trying to get establishment of a new hit franchise, that's still a hit-driven business. Maybe a better example in the traditional gaming world is folks like World of Warcraft, a subscription-based game, reliably $15 a month for at least 9 to 12 months. I think that's what we might start to see with apps of the future now on smartphones.
So how difficult will it be for the Warcraft-type companies to move into this new, more nimble world?
Yep. That's a good question. Traditional game companies, traditional software companies are used to big development budgets. They spend millions creating games and premium software with the expectation you can charge a premium price point for it. Well, let's change that equation. If it has to be free upfront and you have to monetize through transactions in the software, in the application, well, you probably have to drop your upfront development budget by an order of magnitude. So instead of $10 to $20 million to develop a game or a premium piece of software, could you do it for $1 million? Could you do it for $500,000?
Right.
But then do constant add-ons and tweaks and tuning of it, expansion packs and whatnot, and then monetize along the way. That's very different. So it's kind of a whole new art. And the only folks who've been able to figure this out are some of the online game folks, because they're used to operating games as a service. So that learning will translate to apps as a service, hence that term.
Sure.
Yeah.
Sure. If you're a Seinfeld, Jerry Seinfeld fan,
Yep.
which I am,
Yep.
There's an episode that talks about the hand, who has the hand in the relationship. And so when you look at who's going to own the relationship with the customer, in other words, who's going to have the hand with the customer, is it going to be the carriers? Is it going to be the Apple, Googles, or is it going to be some new iteration of the Facebook or Zyngas?
Yep.
What's your opinion?
That's a great question. We're in a state of what I refer to as cloud warfare, because if what we're really talking, when you think back about it, it's not really mobile or online. It's that the world is shifting towards the cloud or the internet. The cloud, by nature, virtualizes and mobilizes everything. You're going to access it from a laptop, a PC browser, a smartphone, even like a game console or set-top box. So the crown jewels in the era of cloud warfare are probably about 4 or 5-fold. There's the billing relationship with the customer. So who owns that today? Right now you've got carriers, right? By the way, also Apple owns that. The magic of App Store was not necessarily just the iPhone or iTunes. It was Apple already having 100 million credit cards, meaning that one-click purchase is doable. Who else owns a billing relationship? Comcast. And I would say that Amazon. Amazon similarly has many, many credit cards there.
Right.
So that's one big crown jewel. A second crown jewel is the address book. It's that contact database. Who has that today? Carriers to some degree through the phone book, right? But even more powerful, Facebook. They own the true social graph, and I would argue that is almost impossible to replicate to the scale they have. So think, if they have the true cloud-based address book, the social graph there, what would happen if Facebook launched Facebook Voice? It's not a stretch of the imagination to see them doing that.
Right.
And imagine the fear that would put in the ecosystem if they did that, right? Just like when Google launched Google Voice, right?
Sure.
So a few other crown jewels in cloud warfare then is the cloud media locker. Where do you keep all your media? Who has all that?
Yep.
Well, Google's got, a good start on that too. Maybe Comcast and others as well, right? And then I would say the content relationship. Who can bring all that content to the consumer? So you've got guys like Comcast are very strong there right now. Amazon. So notice that all these companies are all inching in on each other's territory.
Sure.
Carriers are trying to become media companies. Facebook is slowly adding in more communication services. There's rumors of a Facebook phone someday. Google's already in the carrier business.
Right.
They're going to be a broadband provider. They make phones now. So it's almost like all these large companies are all up in each other's business and will be doing the same things.
Fascinating. Let's talk a little bit about Norwest and venture capital investing. How has this cloud warfare, how is it starting to change the way you view how to invest capital in today's market?
That's a great question. What we have, at least in evolved markets like the U.S., you have this collision of elephants. You've got Comcast duking it out with Apple, duking it out with Google, duking it out with AT&T, all trying to offer a total bundle of these cloud services. So when you think as a venture capitalist, can a startup really become the next elephant?
Yep.
It might be kind of hard. More likely than not, if you just have a specific feature set, you're going to be an ant that kind of gets squished by an elephant. So one thing we think a lot about is how big is the opportunity? Is it something that a Google can quickly replicate? And that's what we refer to as, is it a feature or is it a company? If it's a feature, it's likely then a quick little acquisition. Maybe Google or Apple buys them, maybe for a smaller amount, but they could do it very quickly. That's fine and all, and they can be profitable, but sometimes for venture capital funds of significant size, it doesn't move the needle for the fund return. That's why we're always having to ask ourselves, is this potential investment sufficient and big enough to be a standalone company someday.
Right.
So when you think of the term standalone company, that means an IPO, billion-dollar plus market cap. That means it's got to have a big white space that a giant elephant like a Google or Facebook or whoever couldn't just do themselves, right? And so in that way, sort of, oh, I have a neat app, that's a hard investment for us to often look at as a billion-dollar potential market.
Sure.
A clever app is probably likely a great little acquisition target, but not necessarily a standalone company. That's often why at Norwest, we look one layer deeper. We're looking at, transaction processing systems, enabling platforms, all the other picks and shovels, if you will, that are spread across all the apps, all the carriers, things that could become billion-dollar plus opportunities, right?
You recently closed another round, another fund, and my understanding is you're investing more like a private equity investor internationally. Are you starting to see a bifurcation of the Norwest strategy away from its roots as a VC?
That's a great question. I think we're seeing an evolution of the venture capital industry overall, and your term bifurcation is very apt. You're seeing sort of global funds at the Norwest scale and maybe others like NEA, where we're pursuing opportunities across multiple regions and multiple sectors, both early stage and late stage. And that's why our fund is, our recent fund is $1.2 billion to prosecute all those different areas. We can write check sizes as small as $500,000 as up to $50 million plus. So we're pretty nimble that way. But then the other part of the market is becoming more almost like boutique-focused smaller funds that focus primarily on early stage and maybe smaller deals, and they often have fund sizes that are smaller, so they can capitalize on the the lesser size M&A exits, say 100 million or below, but they can be profitable on those because if your fund size is 25, 50 million, you can happily make a profit all day long on flips to Google or Apple or whoever at 50 million bucks a pop. But it's just different types of opportunities you're chasing. For a fund our size, we have to go for the big enchilada, the billion-dollar plus opportunities.
Right.
But that doesn't mean there's not a whole sea of great investments at the smaller range. It's just kind of a different apples and bananas profile. Yeah.
So, Tim, what's your area of focus?
I myself have been focused on mobile, digital media, and gaming entertainment for a decade. I also lead our China-Asia investment practice here.
So what does that mean in terms of China-Asia practice? What types of things are you looking at in China-Asia versus here in the US?
That's a great question. China is a massively huge market, and it's growing in everything from basic, infrastructure like dams or concrete mixers all the way to the newest Web 2.0 or social media type of investments. I would say for us, we're focused more on technology and technology-enabled services. So as an example, our 3 existing investments in China we've made, 2 of them are services businesses where they're based in China and they leverage China low-cost structure, but service multinational clients. They're doing things like chip design services or logistics, turnkey supply chain for Apple, Amazon, all those sorts of folks. And then the third company is the world's leader in Android customization. So they're like the Red Hat of Android, customizing Android specifically for carriers like China Mobile or handset makers like Dell, etc. So that's sort of a mobile play that's China, yet serves the broader market. So the flavor is almost China deals, but not necessarily attacking the China domestic market, but serving the more global market.
Great. Tim, thanks so much for your time.
Thank you.
Great.